Welcome to Alpha Insights. I'm Nathan, your guide to the world of finance and investments. Today, we're diving into the essentials of investing with our guest, Alex, a financial educator who's here to break down the complexities of the stock market for us.
Thanks for having me, Nathan. I'm excited to help everyone navigate the stock market basics.
Great to have you. So, Alex, let's start with the very foundation. What are stocks and bonds, and why should beginners care about them?
Absolutely. Stocks are essentially pieces of ownership in a company. When you buy a share, you own a small part of that business. On the other hand, bonds are kind of like loans that you give to companies or governments. In return, they pay you interest, and at the end of the term, they return your principal. Both are important because they can help grow your money faster than just keeping it in a bank account.
That sounds crucial for anyone looking to build wealth. Now, Alex, you mentioned that prices in the stock market change based on supply and demand. Can you explain what that means?
Sure. Think of it this way. If more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell, the price drops. These changes reflect how investors feel about the company's future profitability and the risks involved.
Got it. So what about the types of investments? You mentioned stocks and bonds, but what about funds?
Right. In addition to stocks and bonds, there are pooled funds like mutual funds and exchange-traded funds, or ETFs. These funds gather money from many investors to buy a diversified mix of assets. They are great for beginners because they're generally simpler to manage and reduce risk.
That sounds easier for someone just starting out. Could you give us an example of a popular fund that's beginner-friendly?
Sure. One great example is the Vanguard Total Stock Market ETF, or VTI. It offers exposure to the entire U.S. stock market, making it really easy to get diversified in a single investment.
Diversification. Sounds important. Can you explain how it helps reduce risk?
Of course. Diversification means spreading your investments across different assets. So if one stock or bond doesn't perform well, it won't completely derail your portfolio. It lowers the risk of losing money.
That's reassuring. Now let's talk strategy. If someone is just starting out, what are some basic steps they should consider?
First, they should set clear investment goals, like saving for retirement or buying a home. Next, they need to understand their time horizon. Longer time frames usually allow for more stock investments since they can weather market fluctuations. Then, selecting an appropriate mix of stocks and bonds that matches their risk comfort is key. Regular contributions, even small ones, can help through something called dollar cost averaging.
And why should beginners avoid trying to time the market?
Timing the market can be really tricky. It's hard to predict short-term movements, and those who try often end up missing significant gains. Focusing on the long term and making consistent contributions is usually a better bet.
That makes a lot of sense. Before we wrap up, what are some common mistakes new investors should watch out for?
Great question. Some common pitfalls include trying to time the market, over-concentrating investments in one stock, ignoring fees, and reacting emotionally to market fluctuations. Having a plan and maintaining an emergency fund can help you stay calm during downturns.
Fantastic insights, Alex. So what would you say are the key takeaways for our listeners?
Sure. First, investing isn't just for the wealthy. The sooner you start, the better. Second, using low-cost diversified funds like VTI can be a solid foundation for your portfolio. And finally, remember that investing is a long-term habit, not a one-time event.
Wise words, Alex. Thanks so much for joining us today and sharing your wealth of knowledge.
Thank you, Nathan. I had a great time.